You know that feeling when you walk into the grocery store for just one jar of pasta sauce? 30 seconds in and out, right? Wrong. You hit the aisle and suddenly it's marinara, arrabbiata, tomato basil, chunky, organic, low sodium, and that sneaky bottom shelf generic that's 50 cents cheaper but somehow has 200 extra milligrams of salt. You freeze, grab the flashiest label, walk out, and spend the rest of the day wondering if you just poisoned your family. That's investing in 2025. You finally scrape together some cash, open Robinhood or Fidelity, and boom, an acronym avalanche. ETF, mutual fund, index what? Pick wrong, and 20 years later, you're not just eating regret, you're missing out on 6 figures in retirement money. Most people wave this off as boring Wall Street nerd stuff, but here's the contrarian truth. This one choice quietly predicts whether you retire on a yacht or scrape by on Social Security. So let's fix it. I'm Bill, asset allocation obsessive and expense ratio hawk. If market paralysis has ever kept you stuck on the sidelines, make sure you like and subscribe, because today we're breaking down the math, the taxes, and the psychology behind mutual funds versus ETFs. By the end, you'll know exactly which one fits your long-term wealth plan. Quick explanation, or as I like to call it, explain it like you're hungry. Making pizza alone means grinding flour, hunting for pepperoni, and praying your oven doesn't explode. That's individual stocks, messy and risky. Pool your money with a bunch of people to buy one massive pre-made pizza. That's mutual funds and ETFs. You buy one slice of the S&P 500 and suddenly you own pieces of Apple, Microsoft, Nvidia, the market's greatest hits. Ownership-wise, mutual funds and ETFs are basically identical twins. Same ingredients, same pizza, but how they're served and what they charge you for service is where things get interesting. The core difference is timing. Mutual funds work like a restaurant that only settles the bill at closing time. You can place your order anytime, but the price locks in at 4 p.m. Eastern. No intraday drama. You won't know the exact price until the market closes. ETFs, on the other hand, are street food. You can buy or sell all day, every second. At 10 in the morning, the slice costs $5. Bad news drops and it's $4.90. Elon tweets something weird and suddenly it's $5.10. ETFs trade just like stocks. Sounds empowering, right? Here's the catch. That flexibility is a Trojan horse. Instant trades tempt panic selling. One scary CNBC alert and people dump their investments at the worst possible time. Data shows frequent traders underperform simple buy and hold investors by 2 to 3% per year. Mutual funds quietly protect you from yourself. You place a sell order during a meltdown, wait until 4 o'clock, and by then you've calmed down and canceled it. So, takeaway number 1, ETFs give liquidity. Mutual funds give emotional guardrails. Now let's talk about the real silent killer, fees. Market crashes are survivable. Inflation can be beaten. Fees are wealth vampires. The expense ratio is the tiny percentage a fund skims every year. Old-school mutual funds charged 1 to 2% for managers claiming they could outsmart the market. ETFs flipped the game with ultra-low costs. Here's the math. Assume an 8% market return, a $10,000 starting investment, $500 a month over 30 years. A low-cost ETF like VOO with a 0.03% expense ratio ends up around $850,000, with only about $4,000 lost to fees. A so-called smart active mutual fund charging 0.85%, about $715,000. That's a $135,000 difference. That's not pocket change, that's a Tesla. Even low-cost index mutual funds can compete, but the average mutual fund still charges too much. Simple rule, if it's over 0.2%, think twice. Now for taxes, the part everyone ignores until it wrecks them. Mutual funds have a nasty surprise. When other investors sell, the fund managers sell stocks to raise cash. Those profits trigger capital gains taxes, and guess who gets the bill? You do, even if you never sold a thing. These surprise distributions show up every year like a bar tab you didn't order. ETFs use a clever structure called in-kind transfers that avoids triggering those sales. That means fewer taxes until you personally sell. In a taxable account, ETFs can save you 0.5% to 1% per year. Over decades, that's enormous. At this point, someone always says, "But Bill, my broker's Star Mutual Fund beat the market last year." Cool. Let's zoom out. According to the SPIVA report, about 46% of active funds beat the index in a single year. Over 5 years, 85% fail. Over 15 years, 92% lose to a boring index fund. Ivy League managers with Bloomberg terminals get crushed by a simple algorithm. The uncomfortable truth is that betting on active management usually means funding someone else's beach house. Passive wins for almost everyone. The main exception is retirement plans like 401ks, where mutual funds work well for automated investing. So which should you choose? Context matters. In tax-advantaged accounts like a Roth IRA or 401k, taxes don't matter much, so low-cost index mutual funds shine. They allow exact dollar investing and automatic contributions. In taxable brokerage accounts, ETFs are usually the winner thanks to tax efficiency. If you check your portfolio daily and panic easily, mutual funds can save you from yourself. For most people, ETFs are more efficient, but mutual funds won't ruin you if automation keeps you consistent. Bottom line, any low-cost index investment beats doing nothing. You're already ahead for caring. Optimize by using ETFs for taxes and fees and index mutual funds for set-it-and-forget-it peace of mind. Your action steps are simple. Log into Vanguard, Fidelity, or Schwab. Check your expense ratios. Anything over 0.2%, replace it. Your future 60-year-old self will thank you over a steak dinner. Don't let suits skim your empire. I'm Bill. Make sure you like and subscribe for more breakdowns, and comment below whether you're team ETF or mutual fund and why. Your wealth is waiting. Go claim it.